All right, welcome everybody. This is another installment here, just of interviews with our industry partners, different things that are tied into real estate, to really be a source of good information, right? So again, I am Matt Harper. I am joined today with Mitch Friedman, who's one of our preferred lending partners with Pivot Lending Group. So, Mitch, for those that have not kind of seen us in the past or seen you in the past, tell us a little bit about your story.
Excellent. Well, thank you. And thanks for having me on today. I think this is a key time to start talking about what we're going to talk about just based on the market being as strong as it is here in Colorado and the advent of low mortgage rates, which we'll get into more details on, has continued to cause the market to be strong. And being a local mortgage company, we've got our pulse on the market as well as what interest rates are doing. And those two together are very powerful to be able to provide new home buyers and people who are selling homes and wanting to buy another home good information to make good decisions on their next purchase. And so I'm excited to talk through that information with you as interest rates have been in historic lows for several months now. And we'll talk about how long that might last.
Yeah, and for context, Mitch, you've been part of the Keller Williams Avenues office, which is the office that I am out of. You've been part of this office since 2011. Is that right?
Correct. Since the first day they moved into their location, which is almost a little over 9 years. Correct.
Yeah. So for context, been doing it a while, a lot of perspective, and great feedback from the clientele that chooses to work with you on our behalf. So.
Yeah. Oh, great. Yeah, it's been a 30-year run of doing mortgage banking to help people buy homes. So it's been fun, exciting, challenging, and continue to look forward to helping more people in the future.
Yeah. Well, that's perfect. And for those that are tuning in, drop us a line in the comment box. Let us know that you're here, and definitely chime in with the questions that you have. We want to make sure that this is a valuable information that we're putting together. So again, make sure you drop your name in the comment box, ask questions as we have live. We'll be able to kind of interact. So, excuse me, Mitch, this is a topic that you really wanted to cover, is the variation in interest rates, right? So I go and I apply for a mortgage loan, and my neighbor across the street goes to apply for a mortgage loan, and the interest rates are different, even if we may have similar credit. Why is that? And tell me a little bit about why this is so different than when I'm shopping for a car loan and I go to the credit union and they have the same rate no matter what's going on.
Great. Yeah, it's a really good question, and that's something I deal with daily with my clients. And so the piece around mortgage rates has many variables to it, and there are 4 or 5 pieces that really indicate what that final interest rate will be. There is the type of property. So someone's looking to purchase a condominium as opposed to a townhome or a single family residence. The interest rates are a little bit higher on condominiums. The second item is going to be their income level and their amount of monthly bills that they pay, and it's called the debt to income ratio. As that income ratio is higher or lower, that also impacts the final interest rate. The third item is credit, as you related to. Credit is probably the most crucial piece when it comes to interest rates, because that's an indication of past history of making payments on time for future risk tolerances. And then the fourth item is going to be, how long does that interest rate need to be locked in for? So if someone's buying a home and their closing date is within 30 days, we're holding money aside for them for a month. Whereas if they're buying a property and won't be closing for 60 days or 90 days, and which is often used for new home building, then we're holding money for a longer period of time, and there's a cost to that holding period. And so that interest rate could be a little bit higher to cover the cost of that longer period of locking in. So that's kind of the individual impact on somebody's interest rate. And then the day they decide to lock in the rate. You mentioned a great example is your neighbor, or a neighbor said this. That neighbor may have locked in their rate 2 or 3 weeks ago when mortgage rates could have been lower at that time or higher, relative to the day the client says, I'm ready to lock in my interest rate. What are they? And so they're very fluid. They change daily. Sometimes they change 2 or 3 times during the day.
Yeah, so very volatile, right? I mean, it's moving on a regular basis. How frequently are you getting an update as to what rates are doing?
Well, I get updates truly every second. They literally, that's because we have technology and software programs that do that. So I could check rates in the morning for somebody, let them know what the rate is. They make the calls to the people they want to talk to get a second opinion about locking in the rate. And if I'm called an hour or two later, there's a chance that rate could be different. Now, it could be higher or it could be lower. And we've seen both of those take place. And recently, in the last couple of days, they've actually went up a very, very small amount, but they did go up over the last 2 days. And so it just is a fluid, volatile. It's not, the volatility is very little, but there's still volatility nonetheless. And so my advice to clients is if you are very, very happy with where the interest rate is, it's affordable, we're at historical low interest rates, you can't control what the market's going to do on a daily basis or second by second. So consider locking it at that point in time and take that risk off the table of when you're buying a home, because there's so many other things you have to address when you're buying a new home.
Yeah, and the probably the advertising on TV, radio has given us the, if I'm going to be a prudent buyer, I need to be calling around and shopping for interest rates, right? That's what we see for advertising on vehicles. That's what we see, in advertising for, RVs or campers or anything else that I might buy on credit.
Mm-hmm.
And so that's, I'm sure, where the conversation's coming up. Yet there's so many variables that simply calling to ask you what your interest rates are isn't going to give you a good enough picture to give me an answer.
It's not. And that's why we do ask more questions than just, what are you looking to do? So someone may be calling to purchase a home. Someone may be calling to refinance a home. Those rates could be different. However, all the other items I mentioned earlier, credit score, debt to income ratio, type of property, how long they need to lock in for. One piece I forgot to mention is something called discount points, which we'll talk about. All those things will be influential. So if you just look online and do a what's the best interest rate search, or listen to something on the radio, the quote is going to be for someone who has the very best rate, the most equity in their home, or putting a large down payment. They're closing in 2 weeks, and they're buying a home, not a condominium. And there's probably discount points being paid, but it's not mentioned on the advertisement, but it is in the fine print. And so all mortgage companies can offer the exact same way of structuring a loan, but
Well, I think we lost Mitch.
Yep,
Mitch,
I'm back.
We lost you for a moment.
Yeah,
so
sorry about that.
Jump back on that train.
Thank you. So it comes back to being a very individualized quote for each individual. So I will prod and ask those questions to give some of the most accurate information. So if they call and just say, I want an interest rate, I have to ask questions. And that's to be as accurate as possible so I don't give them misinformation.
Yeah, and sometimes consumers might feel like a mortgage broker is being coy or trying to trap them into something, yet the answer is we don't know. There's so many variables, and they're going to change second by second or minute by minute, so we need more information there. So if a buyer is going to be shopping for different lenders, and the interest rate's not the question that I need to ask, what are 2 or 3 good questions that they should be asking between Mitch with Pivot, Bank of America, local credit union, or any other lender? If I'm going to be shopping lenders to make sure I get the best lender, what are some things, 2 or 3 questions, right, that I should be asking?
Sure. One would be, what's your reputation and do you have any references? Is a very good question to ask.
Yeah.
And if you're well known if it's a purchase or a sale transaction, if you're known in the industry as being a good performer, reputable, and closing your transactions on time, that's a great place to start, because that is an important piece of buying a home, especially in this tight market that we're in. The second piece would be, what are your lending fees outside of all the traditional closing costs that a buyer would pay regardless of who the lender is? They're typically called underwriting fees or processing fees or loan document preparation fees. There's a variety of those, and that is really the way to, using the term shopping, that is the way to compare what fees a lender has. If you're being, let's say you recommended me and two other lenders that you do business with, and all three of us perform, then maybe it does come down to, are you charging $1,000 for your closing costs to get your loan through, or are you charging $650? Even that fee is very comparable to most companies because every company does have overhead to cover. Mm-hmm. And then I would say the third question would be, what kind of program selections does your company offer, and how familiar is the loan officer with utilizing those options? Because we could have many different programs available. If I don't know how to use them properly for my client, I can't give the proper advice on choices to make based on different programs that might fit their need better. But if I don't know that that fits better, then I'm not doing my best for the client. So I think those are the three real important questions.
Yeah, from a real estate agent's perspective, I would say that first one is absolutely spot on. What is your reputation in the industry? Because I am very, very diligent about doing our homework. When we have a seller and we're looking at offers coming in, one of the first calls that I'm going to make is to that lender, and I want to know, what's the scenario? What do we have? And there are lenders that have a great reputation. Mitch, you're one of them. There are lenders that, we'll be honest, they do not have a good reputation for closing on time or closing efficiently. And for the seller, we want to make sure that they get to the closing table. That's going to be a big factor in knowing somebody's going to get to the finish line every time, because that's a reputation. That's a big factor in getting an offer accepted, truth be told.
That's correct. And I think, and we've talked about this before, but having a good reputation and being known in the industry could even help a buyer have an offer looked at from a standpoint of how reputable are the different offers with the different parties involved in that transaction. Mm-hmm. And sometimes that knowledge of being able to perform and close on time and be a good communicator, and if there are issues, the issues are addressed up front, sometimes puts the edge to that client's offer versus an entity that nobody's familiar with.
Yeah, without a doubt, I would say that it is for certain. It's happened to clients of ours that we may not have had the best overall terms, yet the lender made the difference in the buyer getting the offer accepted. Now, maybe the seller asked to reach back out. We had to make some adjustments in the offer, or maybe they just took the offer outright, given the reputation of the lender. So that reputation is absolutely critical, and love the fact that you're one of our preferred partners in this, because it certainly makes a difference.
Yeah, how it does, and vice versa. It makes a difference from your perspective as the realtor having a good reputation within the industry as well.
Yeah, oh, without a doubt, it's still, as many of us as are in the industry, it's still a small, tight-knit community. Now, I want to jump to that second question. You talked about the lending fees outside of the traditional fees. So. Mm-hmm. First, what are some of the traditional fees that I as a buyer am going to go through, regardless of who the lender is?
Sure, it's a good question. So there's three or four. So there's not very many for most companies. So one of the fees is called title insurance and a title closing fee. They're tied into the same entity, whoever that title company is going to be used for the transaction. So those fees will range usually somewhere between $1,100 to $1,300. And I can explain what those fees are for if you'd like, or just kind of hold there. But those fees are there regardless.
I think we can have Brenna jump in on a future, what does title insurance cover?
Perfect.
But so we've got title insurance.
You got title insurance. Then you have an appraisal fee. And so the appraisal fee is charged by the specific appraisers who actually physically will go out and do the appraisal. And those fees will range from $575 to $1,000. If it's a large property, if it's a $2 or $3 million property in the mountains, those cause a higher fee just to get to and more work for the appraiser, as opposed to a property that would just be in a traditional community that might run $600. The other fee would be a credit report, and those are going to be run on every single mortgage transaction to determine that the buyer is creditworthy to purchase the home and borrow the funds. And then the last two fees would be the state of Colorado has a transfer tax. So anytime real estate transfers from one owner to the next, the state gets a percentage of that as a fee to the state. It's very small. On a $300,000 property, it would be $30. So it's not a large fee. And the final fee would be county recording fees, and that's a recording of the document called the deed of trust. That puts the property legally into the new buyer's name, and the county charges anywhere between $120 and $175 for that fee. And those will be the closing costs. So there's not really very many here.
So those are the traditional ones, and that's going to be, and I don't want to say standard or universal, but those are going to be more common. If I'm buying a property, less control, and the lender's not going to have as much of an impact on that. What are the costs if I'm shopping that I want to know? What is it that Mitch charges versus somebody else? What are those other fees?
Sure. So they're broken down into many different terms or categories with lenders, but the reality, basically what it is, the big picture is it's a cost to cover overhead. So you'll see things like processing fees, underwriting fees, which is what my company shows, and we charge $600 for a processing fee and $695 for an underwriting fee. However, what that covers is an underwriter, a processor who reviews the files, the closing documents, so all the final paperwork that shows up at closing, the funding of a mortgage to make sure the money is at the closing, the servicing of the mortgage and getting that servicing all put together, all the verifications of employment, verifications of assets. There's just a host of items that take place behind the scenes to get a mortgage. It's all coupled into those $2 amounts that we charge. And a lot of people think that that's not very much money. And they say, how are you guys able to make any money then if you're only charging $1,200 to do my loan? And it's a great question that comes up all the time, because many years ago, buyers used to pay what's called a 1% loan origination fee. Mm-hmm. And that origination fee went away in 2010 with the changeover when we had the real estate challenges that we had. The government said, no more charging of that fee. You can't do that anymore. And so the fees dropped quite a bit from the very beginning at that time, because now 1% of a $300,000 mortgage is $3,000. So now closing costs run on average between $2,500 to $3,300 for all those items I mentioned earlier. The big variance there would be whether an appraisal is required for the transaction or not required.
Yeah.
So other companies may have fees that are $2,300. I've seen them for $700, but then they put that fee somewhere else. And so so I don't want to say there's certain ways of doing business in our industry, because we've really tried hard to clean up that type of not providing accurate information in the very beginning. But there are ways that the client can choose to cover fees and not fees.
Yeah.
And we can build that into a higher interest rate. That's another topic.
Well, for sure. So, and to kind of pull back the curtain, so to speak, on a home mortgage from mm-hmm. start to finish, it's not just Mitch doing all the work. And I think that people, even real estate agents themselves, people get lost in how many people are involved or touching a file. So from your company, your perspective, mm-hmm. right, I get a mortgage. How many people are looking at or involved in that process from start to finish?
Sure. So I'll speak it as I count it, because I don't have that amount memorized, and it changes sometimes. So there's myself, and then we have what's called a loan officer assistant. Then we have a processor, and then an underwriter, and then a funder, a closer, the servicer, and then something called the secondary market. So it's where the loans ultimately get transferred or sold to. And so that's 7 people, not including any other support people that jump in when we need them. So there's quite a few people.
Quite a few people that are diving into that. So, a lot of people connected into it because it's a big thing. And I think it should be, if I'm going to get a $500,000 loan, there should be some eyes on that file to make sure that I'm responsible and doing what I'm supposed to.
Correct. And also, ever since, again, the challenges we had in 2010, the government stepped in as well and said, loan officer, you are not allowed to go and order an appraisal ever again. Mm-hmm. Loan officer, you cannot do a verification of employment on your own, because there's a conflict of interest for us. So now we had to hire up more people in order to take those positions over, when sometimes we would jump in to help out and get those things ordered quickly. We're not allowed to anymore, which I fully support, because again, things were being done that they shouldn't have been done the way they were being done. So it's become more expensive to run a mortgage company at the same time.
Yeah, which is it's interesting. It's become more expensive, and they're getting rid of some of the fees. I remember when I bought my first mortgage, there was a loan origination fee. He normally charged 1%.
Mm-hmm.
He also did my mom's loan. My mom told me to ask for a discount, and we got it down to 1/4%. But I guess things have changed since 2010 on that.
Yes, we're not allowed to do that anymore.
Yeah. So if I'm listening to the radio or looking on Facebook or social media, watching the Broncos games, I'm going to hear a commercial for a mortgage company.
Mm-hmm.
And frequently I'm going to hear something about a no-cost loan, right, or no fees. So tell me a little bit about kind of why that might not be exactly as being advertised.
Sure.
And can you do kind of the same thing for somebody?
Yeah, that's actually a really good question, because I get that asked quite a bit due to a lot of the advertising. And so there is never a no-cost mortgage. What there is there a way to absorb the costs into the mortgage somehow? And the most common way of doing that is mortgage lenders can legally raise the interest rate, of which we then use a what's called a lender credit. So we get money back from Fannie Mae when we deliver a loan to them at a higher interest rate than the market really is asking for. So a great example is if the mortgage rates are at 2.75% and a client pays $3,000 of their own closing costs, they'll get the very lowest rate. However, I could present to a client and say, instead of 2.75%, let's take your rate to 3%. Or 3.125%, and we will absorb that $3,000 closing costs based on moving your rate up to handle those closing costs. And that is a no cost out of pocket to the borrower, but it is not a no cost transaction. Yeah. And there's a big defining point there that we talk about all the time, and clients make decisions, and it's a really good option for a client. They don't have a lot of cash to work with, or they buy a home where that home needs some improvements, and they want to save that $3,000 to do the improvements or buy appliances or whatever they need to do. It's a great way to hold their cash and have a little bit higher monthly mortgage payment, as long as they can afford it and it's comfortable for them.
And depending on what my interest rate was, if I'm refinancing, or what I want to do with those cash, it may take a number of years to recoup the cash that I put. So it just becomes a numbers game. What do I want? Do I want the cash today? Do I want the lower payment? And that's why having a conversation with somebody that's super knowledgeable has a huge impact, because it's not just playing checkers, where ultimately this is a little bit of a strategic game that we're playing when it comes to the mortgages.
Correct. And the nice thing is there's options and there's choices, and they're not complicated if they're laid out in a way that is really math, very simple math. Yeah. And that's my job, and my goal is to make sure I can lay that out to people to make good, solid decisions based on good information for either a short-term transaction for them. If this is my first home, I think I'll be here 3 to 5 years, or it's an investment property, I'm going to own it for a very long time, or it's a home that we feel like we can see ourselves in for 15 or 20 years. All of those scenarios require different decision-making on what type of home loan to access at that time. So that is really the fun part of my job, actually, is to have those kinds of conversations. That's where I feel I add my best value.
Well, and it's so important to have a strategic partner that's here with you through this. And why we love working with Mitch, because Mitch is that strategic partner that has a great understanding of the industry, has a great understanding in knowing what somebody's goals or objectives are, so that, one, you can pick the right program, the right lending, the right scenario for them to walk into that's really kind of custom made for them.
Correct. And that's the beauty of having so many options to pick from. Even though there really aren't 100 mortgage programs like there used to be, there's a good solid 10, and those 10s have some wiggle room with inside each of them to help fit the needs of the client in whatever their situation is.
Yeah.
Yeah. So.
Yeah, perfect. And that's kind of run through the questions that I have now as we talk about why my interest rate might be different than your interest rate, even if we both have similar credit. Is there any final pieces that you want to convey here for those that are watching?
Yeah, I would think the other part, the other piece of that would be if things are changing economically from the time your neighbor locked in their mortgage rate to the day that you have a decision to make on locking in their current interest rate, there could have been a lot of information coming out about unemployment or producer price indexes that are causing mortgage rates to either go up or down. And typically, when rates go down, I get very little questions. Typically, when rates go up, there's a lot of questions. And they want to know, why did rates go up? Because they weren't up 2 weeks ago. And so I have to be ready for those questions and have good information. So I track that very carefully. And that is one very important that a lot of people don't pay attention to because it's not part of their daily lives like it is mine. And so that's why I earn my income based, and I feel, to your point, being a trusted advisor from a standpoint of why things are where they are and at what point do you make a decision on that.
Yeah.
So the economy is a huge piece that we haven't touched on and that nobody has control over. It just comes out when it comes out, and we talk through those options.
Yeah. Well, and I also want to put the asterisks here for when your neighbor tells you their interest rate. It's kind of that water cooler conversation. Everybody wants to pound their chest and brag about the low interest rate that they have. And I'm going to drop a bombshell here for everybody. They may not be 100% accurate in the information that they're sharing. They may be mistaken, or they might just be puffering a little bit to tell you they got a better interest rate. That's something that's real, that it happens. Don't feel bad if you're in a scenario where your interest rate's slightly higher. One, a lot of variables, a lot of things might be different. Two, that may have been the absolute best position for you to be in. Your neighbor might have brought a lot of cash down to buy that interest rate down, right?
Mm-hmm.
So a lot of things there.
Yeah. Well, and a lot of people just forget what they did to get that final rate because they just don't do this every day. So they made just good decisions in the moment they were presented with the information to make that decision. And then if you're standing across the street from each other, you just don't remember all the details. So it could be, to your point, they could have bought down the interest rate and paid a lot of money to get there.
Yeah. Overall, interest rates are at historic lows. If you're
Correct.
thinking about buying, you have a lot of buying power. If you haven't looked at refinancing lately, something to look at could be saving thousands of dollars without actually having to bring any cash out of pocket for it. So something to take a look at. Mitch may be a strategic partner for you as it comes to those. Definitely reach out to us, let us know. Mitch, again, I want to thank you so much for being on this.
Sure.
We will definitely have you back. And I think this was a fun conversation and a good conversation for people to have.
I agree. Thanks for having me. And I think keeping an eye on the market, if you're interested in buying a home, this is now the time to do it based on low mortgage rates. And to your point, they are historically low. Look at a chart, you'll find it. It's very easy to track, and take advantage of it. And if you've been thinking about buying a home or refinancing, I'm always available to help answer those questions.
Awesome, Mitch. Well, again, thank you so much. I appreciate your time. And again, thanks for everybody here for tuning in, and we'll catch you again here in a couple of weeks with the next interview.
Great. Thanks, Matt. Have a good afternoon.
Thanks, Mitch.
Bye-bye.